Welcome to Inside Economics. I'm Mark Zandi, the chief economist of Moody's Analytics, and I'm joined by my two co-hosts, Cris. Cris is the deputy chief economist, and Ryan Sweet. Ryan is the director of real-time economics. Hi, guys. How's it going?
All right. How are you doing,
Hanging in
Mark?
there? How you doing, Mark?
I see Cris is in the office. Cris? Yeah,
Yes.
you are.
Yeah.
And Ryan, you're still at home. And
I am.
I think we're going back soon, aren't we? I saw some kind of email from
I think mid-April.
mid-April. Is
Yeah.
that when people are going back? I guess you can go back already if you
can come
want,
back.
but
Yeah.
you're back
Anytime.
anytime you want. So what's the April date exactly?
I
Do you
think
know?
that's an official welcome back.
An official
office.
welcome. Okay.
Yeah.
Always good
Where-
to have an official
Where are
welcome.
you?
Actually, I'm in Sea Island, Georgia, at a very interesting kind of think tank function, and talking about economics and stagflation, the kind of things we talk about on this podcast, and also defense policy, national security, which obviously, given Russia, Ukraine, and China and everything else, very interesting. Not something I get to listen to very often, but fascinating and very important. So that's what I'm doing down here in Sea Island.
Well, I appreciate your dedication.
Yeah,
Lugging
you
the
see, I
microphone.
I even
Yeah,
I even walk around with my mic. I mean, I brought my mic to
not
this.
like Cris. Cris
Yeah.
goes on vacation, leaves it at home.
Yeah, he's speaking from the
Yeah.
wine cellar or something.
Yeah,
I brought the headphones, so hey.
yeah,
you know.
you did.
Yeah, good point. Good point. That does show dedication. Okay, this podcast, we will be talking obviously about Russia, Ukraine, what it means, but through the prism of commodity markets. What does it mean for oil, natural gas, and then non-energy commodities, agricultural products and industrial gases and metals? These are things that Russia, Ukraine export to the rest of the world, and obviously those markets have been turned in upside down by events. And that's the key link between what's going on in Russia, Ukraine, and the rest of the global economy, including here in the United States. And we want to talk that through with a number of our colleagues that are experts in these markets. So I'll bring those folks in as we continue the conversation, but we're going to do a deep dive there. But before we go down that path, though, and not unrelated, obviously, is the big statistic of the week, economic statistic of the week, was the consumer price index that was released on Thursday. So yesterday seems like a long time ago, but just yesterday. So Ryan, maybe I can turn the conversation to you, and you can give us a lay of the land. What happened there? It was obviously pretty ugly, but maybe you can give us a sense of that.
Yeah, it was another ugly month, and it's going to get worse. March is going to be much worse than February. But the CPI, the Consumer Price Index, was up 0.8% between January and February. That's compared to a 0.6% increase in each of the prior 2 months. So we're seeing a little bit of an acceleration month over month. On a year ago basis, the CPI was up 7.9%, which is the largest increase since the early 1980s. Going through the details, energy was a big portion of the increase in February. So you saw the CPI for gasoline was up 6.6%. And that doesn't fully capture the recent increase in gasoline prices. So we're going to see a big contribution to March CPI through gasoline prices, but it's not all energy related. You saw some of the reopening components of the CPI, reopening related to COVID. So lodging away from home, airfares, they all rose. Now, some of the airfare increases, jet fuel prices, they kind of track each other, but also demand. It's also demand driven because Omicron variant, number of cases are falling, number of people going through TSA checkpoints increased. So there was a big pickup in travel. So there was some demand increase there. The key shelter component, which we're all keeping a close eye on because that's going to really start to accelerate soon. That rose a trend like 0.4% for the 6th or 7th consecutive month. Rents are usually pretty sticky, but we're going to see some pickup in rents going forward. So if we don't get some good disinflation, some weakening in price growth, we're going to have bigger inflation problems, the summertime, because services inflation is really starting to pick up.
Yeah, there was also a big increase in food prices, correct?
Food prices, yep, great point. Yeah, they're up 1% month over month.
Of course, that's also in part energy related because a big
Correct.
part of getting food on the store shelf is transportation, and that's fuel. So that probably played a role. So
Even like the core CPI, where we strip out the volatile food and energy components. I mean, that rose 0.5% month over month. But even there, energy plays an impact. And any good that's transported, diesel prices, fuel prices, all factor into there. So the core CPI doesn't remove all of the impact of energy.
Right. But the 0.5, that wasn't really. I don't think that was an acceleration month to month, right?
No, it was a deceleration.
It was a
0.6
slowing
each
in
of
the
the-
growth,
Correct.
and that goes to some good news in the report, right?
Yeah, used car
At least
prices
from-
dipped
Yeah.
0.2%. I mean, you got to squint to see the decline, but
No, I
it's-
know, but what the message there is a broader message, though, isn't it? I mean, at least
Yeah. At
right?
least that in February, price pressures
Yeah.
weren't, within the core CPI weren't broadening out too much. I mean,
Well,
there's
yeah. Also, I mean, we've been making the case that once supply chain disruptions start to abate, and we saw enormous supply chain disruptions, beginning back last summer and fall with the Delta wave of the pandemic, particularly in the vehicle industry, because all the chip plants in Asia shut down. You couldn't get chips, you couldn't produce cars, you got shortages, and we've seen a skyrocketing in vehicle prices. But it feels like vehicle prices are starting to level off, and that goes back to, well, chip plants are now open. We're getting some pickup in vehicle production. Inventories are no longer falling. Still shortages, but it's not getting worse at least. And that's starting to cause prices to level off. And hopefully that's the start of that goods price deflation you were just talking about. Maybe we see some big declines here in car prices later in the year.
right. So I think that over the next few months, the big story is going to be energy boosting the CPI. But at the same time, you got to look at the details because we're already starting to see some evidence that, to your point, that some improvement in supply chains, because our U.S. supply chain stress index, which takes a number of measures of stress in the supply chains, has actually improved over the last few months, and that's starting to show up in some of the inflation data that we're getting less inflation from supply chains.
So top line really ugly, got worse, higher energy prices. That's kind of affecting lots of different things: food prices, airline ticket prices, things more broadly. But underneath that, it feels like still high rates of inflation, but it doesn't feel like it's getting worse. Maybe we're starting to see signs that it's going to get better. Would that be a fair way to characterize it?
I think so.
Okay. And can I ask one other question? Going back to Russia, Ukraine, how much of the increase in oil energy prices that's in the CPI report would you ascribe to Russia, Ukraine?
For February or March?
February.
February is small, a small amount.
Really? You think you really think that, huh? Because my sense is oil prices started rising at the beginning of the year, and that's when Russia and Ukraine got on the radar screen, and that's when oil traders started sending up oil prices, even before they invaded.
Yeah, I was thinking the actual invasion from that day point. But if you go back when tensions started to escalate, commodity traders started putting a premium on oil, then yes, most of it would have been attributed to Russia, Ukraine, and it's all in March.
Right. I mean, in kind of my simplistic framing of what's going on here, oil prices back before Russia, Ukraine came on the radar screen at the end of last year was $75 a barrel. As Russia, Ukraine came on the radar screen, as it looked increasingly likely as the year started that Russia was going to invade Ukraine, oil traders says, oh, that's a problem, and started driving up oil prices. And that began in January, but really became evident in February, because by February, oil prices were not quite $100 a barrel, but they were pretty close. So up $25 a barrel. And then you had the invasion that coming into March, and now we're at, I didn't look today, but
110.
110, something.
Give or take.
Yeah, give or take. Yeah, okay.
Either
Cris,
of your numbers, $294.50.
What's that?
Is your number $294.50?
Oh, that's the increase in. We're already playing the game. It sounds like.
No. I just wonder,
Right.
is it your number? Because I won't talk about it if it.
No, that's not my number. But the 294, I think, is what you're saying is as of February, that's the increase in the monthly cost of living. So for a household, typical household that wants to buy the same stuff they did a year ago, today they need to spend $295, almost $300 more a month to buy that
Correct.
stuff.
Yep.
Yeah.
So that kind of highlights the cost of inflation.
Yeah, the downside, the negative hit
Correct.
to disposable incomes, real incomes. Yeah, right.
Mhm.
Chris, on the CPI report, anything that Ryan and I missed in our conversation that you want to point out, or anything you push back on with regard to the conversation?
No, not really. The owner's equivalent rent, right? Housing component continues to rise, right? That's 4.3% year over year. So that's going to continue to feed in. That's not going to bend very quickly, right? Unlike energy and food potentially. So that's going to continue to have an effect over the next few months. That's all I would suggest, right?
Yeah, next few months or
I think so. Yeah, because
longer.
There's longer, right? Because it's
Longer,
typically a
right.
1 year lag between house price
Yeah.
increases and the rent increases. So
Yeah. And just for context, correct me if I'm wrong, but the housing all-in component of the consumer price index is about a third of the index. So the Bureau of Labor Statistics that puts the data together, they calculate prices for all these different products and services, housing being one of those things. Then they kind of create a weighted average, and the weights are the share of that product or service in the consumption basket and the percent of what the typical household spends, every month on these different things. And if you add up housing, and this is out of pocket expenses, and housing accounts for about a third of the index. So it's a big piece of the pie here.
It's a little bit more now.
Oh, is that right?
With the new weights, I'm looking at it right now, it's 42.4%. That includes shelter, OER, owner's equivalent rent, and then also utilities. So if you strip out,
but that's got to be the share of core inflation. That's not overall inflation.
overall,
No, I don't think so.
I have it right in front of me. I'm staring at
No,
it.
wait. The housing component accounts for 42% of the overall index?
That's what
I
it
don't
says
think
right
so,
here.
Ryan. Yeah, take a
All right,
look.
I'll
It's
double
high.
check.
Yeah. What do you think, Chris? Is that right?
that sounds high to me.
That
but
sounds really
You're saying
high.
it's new weights? I mean,
No, I think that's the share of the core.
Maybe
I think.
maybe it's the core.
it could
yeah.
be. Yeah.
Yeah. But
I'll double check.
let us know when you get there. But still, nonetheless, it's a big component. Just for context, I think energy all in, and that's fuel oils, everything, is 7% of the CPI, something like that. And food, 14%. So food and energy is about 20% of the total CPI. So
Yeah, you're right. That was the share
Yeah.
of core.
That's share
The headline
core.
is 32.8%.
33.
So you're right.
Yeah.
Yep.
33%, 1/3 of the. Hey, don't fool with the chief
I know,
economist,
see.
is what I
Yeah.
say, especially when it comes to data, right?
Mhm.
All right. Yeah. I'm just saying. Just remember that. Just remember that. Okay.
All right.
No, I get my fair share of statistics wrong for sure. Okay. Let's play the game,
right.
the statistics game, and just remind folks here we each of us throws out a statistic, and the rest of the group tries to use deductive reasoning to figure out what that statistic is. The best statistic is one that is not so easy that it's a slam dunk. But it's hard. It's not too hard that we'll never get it. It's nice if it's kind of related to it has to be a statistic that came out that week, more or less. I take license with that every once in a while, unfairly, but that would be good. And if it's related to the topic at hand, which in this case is Russia, Ukraine, oil prices, inflation, that kind of stuff. But again, these are loose rules. So did I get the rules right, Ryan?
Yeah, you got it.
Because I know you're a stickler for these rules.
Yeah,
I
you're
got it
good.
right.
You got them right.
I got it right. Okay.
Yeah.
Good. Very good. If you do well at this game, you get a cowbell. So, and I can see one of the cowbells over there
right
in the
here.
corner, and there's one right next to Ryan. Okay. Very good. Okay. We all strive to get a cowbell. Okay. Who wants to go first? Chris, you want to go first?
Sure. 527.
Is that
that
527? Is that
527.
527?
Dollars?
Nope.
Oh, is it related to the CPI?
No.
No, I didn't think so. Was it related to the other big number that came out this week that we didn't talk about is the job opening labor turnover survey, JOLTS?
Nope.
No, wasn't that? It
No.
wasn't hires or quits or anything like that. No.
No.
Is it gasoline
527.
related?
Is it? Go ahead, Ryan.
What's that?
Is it gasoline related?
It is energy related.
Energy related.
527. Okay, I am going to bring in
Close.
one of the other guests because they may be able to hang with you, Cris. I'm going to bring in
better.
Cris
They better.
Lafakis. Cris, welcome to Inside Economics.
Hi, Mark. Thank you.
Cris, is this your first time on Inside Economics? I can't remember.
It's my second time on the pod.
Oh, it is. Okay. And how'd you do on the first one? I can't remember. How were your reviews? Did you get good reviews from the audience? I can't.
Did I get one thumb up?
One thumb? Okay, one
Oh.
thumb. That's pretty good.
We can't aspire to get two thumbs. I mean,
Right. And Cris is one of our experts on the oil market and energy markets more broadly. And Cris, do you have any idea what Mr. DeRides is talking about here? Dr. DeRides, I should say, 527.
so is it a price?
It is not a price.
Okay.
Barrels?
Is
What?
it a quantity?
Yeah.
It is a quantity. Yes, yes, it is a
Oh,
quantity.
it's
Oh,
not.
there
Does
it
it have to do
goes.
with oil rigs? Oil rig counts?
Oh, bing, 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 bing.
Yeah.
Oh
No
my
way.
gosh! Oh, baby!
So what is it?
That is your
Specific-
most impressive one.
What are you talking about? I've had many impressive ones over the past.
That's
year.
more. Yeah. 520. That's good. That's impressive.
And I schooled Mr. Lafakis, the resident
yeah.
expert. Yeah.
phone a
okay.
friend didn't
Explain,
work.
explain, Cris. What's going on there?
That is the U.S. oil rig count as of
Active rotary rigs, active
Active
rotary
rotary-
rigs, Baker Hughes, rig count, weekly count. Very well done, Mark. That was amazing.
Oh, I think he's now sucking up. What do you guys?
Yeah. Don't worry. Mark won't get my numbers.
Yeah. Right. So, Cris,
Bring it up.
527. Give us context, okay?
Yeah, that is up 8 rigs in the week, right? So that's
that a
pretty
lot?
significant. That is
It is
significant. It is
Okay.
significant. It had been relative. Well, it had actually been growing recently as the price of oil has gone up. But 8 in a week is a pretty sizable jump. It was actually flat the week before, and it's up 218 from a year ago. And for those of you who
Oh.
care on the pod, it is actually up 238 from the time President Biden took office.
Although it's still low, isn't it,
It's still low
compared to
pre-pan-
pre-pandemic?
Correct. Pre-pandemic, it was 683.
683. So, and so
it's
we're moving in the
increasing.
right direction. We need obviously more oil, given what's going on, and it feels like you're saying that they're increasing, the rig counts are increasing, and they're increasing at a pretty good rate here now. That's what
At least
you're
in the
referring
last week, in the last couple of weeks. Yeah.
last few
So
weeks, right? Which makes sense, right? I mean, because at these oil prices, these guys can make a lot of money, right?
You would think, right?
You would
But,
think.
they're also, the drillers are also indicating that, they've got their own supply chain issues and trouble finding workers. So they can't accelerate as quickly as perhaps we might otherwise expect given these prices. There's also uncertainty around the price itself, right? So they're not going to rush to the oil fields if this is a temporary increase.
We need that
Okay, I'm
increase,
gonna-
though.
Go ahead, Ryan. What were you saying?
I was going to say that the rig counts feed into GDP in non-residential structures investment, and that helps offset some of the hit to GDP growth from weaker consumer spending because of higher prices at the pump.
Yeah, that's right. So when you think about oil prices and how they impact the economy, it's cross currents, right? The negative hit to the economy is what we talked about. If you got to put more money into your gas tank, as a consumer, you have less to spend on everything else. Therefore, less spending, less production, that's less GDP. So it's a hit. But the positive is that the U.S. produces a lot of oil. We produce, I think 20, Cris, correct me if I'm wrong, but 20 million barrels a day, give or take, which, by the way, is a lot of oil. That's, 100 million barrels a day globally. So 20 million barrels is a lot of oil. So it's a big part of the economy. And so if you get higher prices, that lifts rig counts and production and investment. And so the net of all that is still a small negative for the economy, but it's a small negative. It's not a big negative.
Correct.
It's a small correction. We consume about 20 million, but we produce about 11.6 million. But I mean, this is the most substantial increase in the rotary rig count since 2015, 2016, when, you know, that was a near-death experience. That was akin to the 2008 Great Recession for a lot of these mid and small-size oil drillers.
Oh, I got that wrong. So we consume 20 million barrels. We produce how many barrels?
11.6 million barrels per day. And about 8 of those are, so that gap is like we import around 8, and we export around 8 or 9, but the US consumes about 20 million barrels a day, but only produces about 11.6.
Well, square that circle for me. I'm not following the arithmetic. So 20 million we consume, we produce 10, imports and exports kind of net out.
Well, we import a lot of product too. We import a lot of product. So 20 million is kind of the, demand is measured as petroleum products supplied. So that's oil plus diesel plus jet fuel plus heating oil, all of those together. The US's entire consumption is about 20 million barrels per day.
Oh, you're saying crude plus the refined product is 20 million.
That's correct.
Okay.
Yes.
Yeah. Okay, so but we produce 10 million in crude, and how much of crude do we consume? 10?
How much do the refineries use?
Yeah.
It's around 14 million.
Boy, I'm so confused with these numbers. Yeah. I don't know. How does this all add up?
There's a distinction between, oil and petroleum products, and so the U.S. is, if you can think of it, very close to like a net neutral. We were a big importer, but now we're net neutral.
Okay, I'm going to bring
close
in,
to it,
because I saw a hand. I'm going to bring in 2 of our other colleagues that are also oil experts, energy experts. You can see this is a lot of moving parts here, so we need a lot of expertise. Tom Nichols. Tom, welcome.
Well, thank you.
And Tom, is this your first time on Inside Economics?
Yes, it is.
Okay, welcome. It's good to have you. And how long have you been with Moody's Analytics?
Coming up on 7 years.
Really? I didn't know that. It feels like you've been around for like 17 years. I don't. That's good though. 7 years, good. And Juan Pablo, Juan, you've been with us for 17 years. No? How long?
Almost. Maybe like 14. I lost count.
Yeah.
Many years.
many years. Okay, Juan, you raised your hand. Can you kind of put these numbers, get them squared away here?
We produce. So the 20 million barrels is, as you said, is products. So that is not crude oil. That's like what refineries produce, and that's $20 million barrels. So from that 20 millions, we produce 11.6 crude oil. But we also produce another like 7 to 8 million in byproducts.
Got it. Okay.
So in total, you have 11.6 crude. You have to add the 8 that is the products, and this includes natural gas, plant liquids. That's a big one. That's like almost 6 million barrels, and that's like a byproduct of crude oil extraction. And then you have refinery processing gains, and that's like another million barrels. So overall, the U.S. produces between what it produces in crude oil and products, I would say it's close to 20 millions, because we are basically right now like not a net importer or net exporter. We're like in the middle, where we produce as much as we need to consume.
That makes perfect sense. So it's 20 million in consumption, 20 million in production, kind of what I was saying. But you got to make this distinction. That's what these numbers get confusing, because we're making a distinction between crude, kind of the raw material for these end use fuels, and the number 20 million also includes the final product.
Correct.
Got it. Hey, I got one other question. So when you look at the data that comes from the EIA, the Energy Information Administration, that does a lot of this data calculation, they say, I think, correct me if I'm wrong, that global consumption of crude is 100 million barrels a day. Is roughly? Is that correct?
That's
not refined
products.
product. That's crude, isn't that
That's
right?
no, that's oil liquids. That's what they call oil liquids.
Oh, so that does include refined product.
So that's
Yes.
that's everything. That's
Okay.
that you don't consume crude oil directly.
Got it.
You
Yeah.
you consume products.
Yeah. Okay. So
Right.
100 million barrels is so of the 100 million barrels a day that we of everything that fuel, crude and refined product, 20 million is here in the United States, roughly.
Yeah,
It's
right.
20% of the pie. Yeah.
We are still the biggest consumer of
We're still
oil.
the biggest consumer, but the good news is because of the increase in production due to fracking and all
Right.
the natural gas and oil, that now we are, we basically produce what we consume, and so therefore that's kind of the key statistic we're trying to understand what the impact of higher prices or lower prices means for the broader economy, and it's saying pretty much a wash. A negative for consumers, a positive for producers, but net kind of like washes out. In our calculations, just to give people a rule of thumb, for every $10 increase in the price of a barrel of oil, you get a reduction in GDP, the valuable things we produce in the subsequent year, of 0.1%. That kind of gives you a sense of it. Yeah.
I would say that it's still a net negative for the US economy because the distribution of the gains is different from the distribution of the expenditures. So for instance, you've heard how, energy, there's a lot of historical opposition to raising the gas tax because people say it's regressive. It hurts people on the lower end of the income spectrum the most, that have the highest propensity to spend. Whereas, on the producer side, a lot of those are, rents that are collected and paid out in the form of dividends or share buybacks that benefit consumers that have higher savings rates. So if you actually measure the net economic impact, even though the US is, energy independent, if you will, 20 million barrels in, 20 million barrels out, it's actually negative for the economy.
Yeah, I think that's what we're finding, right? I mean,
Yeah.
but it's small negative, at least
Yes.
at least at prices that. I mean, if you get from, I think it might be different. If you go from $75 a barrel to 85, that's different than going from 150 to 160. I think
Yeah.
it's kind of an economist would say non-linear relationship. But at the prices that were normally prevailing, 75, 80, $100 a barrel, a $10 a barrel increase results in a 0.1% reduction in GDP for the reasons you nicely articulated, Cris. Tom, anything else you want to add on that conversation we just had around oil?
I think we're going to circle back around to it.
Yeah.
So
Okay, fine.
yeah.
Yeah. Perfect. Hey, there's one other before we continue on with the game. Maybe this is a good time to talk about one other aspect of oil and energy markets, going back to Chris's statistic, and that is there's been this hand-wringing and debate and discussion about why haven't there been a bigger pickup in oil production in the United States? Why aren't there more, oil rigs are rising and they're rising more quickly, but why did it take so long? Why aren't we seeing, why isn't it why aren't we back to pre-pandemic levels, 680 on the rig count? Why are we still below? So, Tom, you want to weigh in on that? And obviously, there's a lot of debate. It's getting into the, it's getting a little politicized now too. We had a webinar. I expressed my views on it, and I got a lot of pushback. And you could feel the kind of the political tension, starting to build. And we don't want to do that. We want to be clear-eyed here. But so, what's your sense of what's going on here? Why? Well, first of all, do you agree with that characterization of what I just said, and what's going on?
Yeah, so I think there are a couple of reasons that we're not seeing drilling at the same pace that we typically would at this price level, right? In the past decade, really, U.S. producers have been really aggressive. As soon as they see prices jump, it's drill, baby, drill. And that has not really materialized in sort of the post-COVID environment. I think one reason is a lot of oil companies got locked into low spending plans during COVID. So they were a little bit slower off the floor than they would have been. So that effect at this point has kind of gotten washed out. But I'd say initially that was an important cause. Currently, I think a lot of it is due to the same supply chain issues that we're seeing in any goods producing industry. We're talking about the difficulty you get with inflation, difficulty getting materials, difficulty getting labor. So all of those things are affecting the oil market as well. A lot of oil companies are talking about the increase in price for the metals that they need to finish the wells, encase the wells, the sand that they need to frack wells, the fracking proppants they call them, that they use to actually extract the oil. And then another effect that we're beginning to see is an increase in capital costs. There's starting to be a push amongst lenders, amongst the financial industry, to decarbonize their lending portfolios, basically with the expectation that climate change or climate change regulation further down the line is going to have a negative effect on certain industries, mining being really chief amongst them. So that is beginning to take effect, as well as the increase in capital costs, along with the regular supply chain issues that everyone's facing.
Okay, so it's a range of reasons, not one. So
Yeah.
Again, reiterate. Number one is what? Reason for the slow pickup?
Initially, I would have said it was the getting locked into low expenditure budgets coming out of COVID.
Number two,
Supply chain issues.
and that's everything from labor to materials.
Yeah, labor and
sand or
materials.
whatever they need.
Exactly.
Right. And three is
3 is capital costs.
the cost, just the cost of capital here to actually, given the shift in capital markets related to climate change and fossil fuels and that kind of thing. Okay.
Yeah.
Okay, I'm going to stop right there. I'm going to go to Cris Lafakis, and then I'm going to go to you, Juan. In your mind, did Tom get that right? Is that ranking is how you would rank things, or would you rank them a little bit differently? Or is there another factor that he didn't mention that you think should be mentioned in the top three?
Yeah, I would probably add 3 factors. I think that there are a lot of
Different
the factors
factors, or the same factors, or different factors?
I would build to what Tom said. So 3
Okay.
additional factors.
Okay.
He's right on with, in terms of, the increase in input costs that are constrained. We have constrained supply. We have, and in COVID, and then obviously capital costs as well, which is a big part of this. We're sitting here. Another perspective that I would add, though, is we're sitting here. This is Sarah week, so this is the one week in the year where the who's who in the oil industry gather in Texas, and they meet and they talk to each other. And a lot of the CEOs are talking to each other right now, and they're saying, we're doing what our shareholders want. Many of us, almost went bust in 2015, 2016. And the message that we heard from shareholders loud and clear is retire debt, buy back stock, and pay dividends. And these strategies have been very successful in lifting company stock prices. And the people that are making the decisions are CEOs, and they're compensated based on how their stock price performs. So they're listening to the market. The market is saying, this is what you need to do to get a better valuation. And they're doing that. So I would say that reason number 4 would be shareholder pressure, or the decision to not reinvest capital that is earned, and instead use that to retire shares and institute buybacks. I would say that reason number 5 is, after we came out of the global financial crisis, it took us a while to get our mojo back. Those animal spirits really didn't start roaring until 5, 10, 15 years down the road. And many of these small and mid-sized producers were shell-shocked. They suffered near-death experiences, and they're very reluctant to, put it all on the line again so soon. They want to make sure that the price increase is a little bit durable. And then the last reason that I would add is—
Can I just say on that one, that feels kind of like a variation on the theme of Tom's number 1, right? Would you, Tom is saying, everyone got creamed in the pandemic, getting everything revved back up is going to take some time. That's kind of sort of what you're saying, right? Right, Tom?
Sure.
Did I get that right?
Yeah, I think what Cris is highlighting is that this trend is, it's past the COVID point, and now we're seeing prices leap for another reason that is not necessarily tied to the market. And how much can we actually invest on this? Can we go to the bank on the recent price increase or not?
I see. Okay, fair enough. Yep.
Right,
Okay.
Cris? Is that?
That's right, because of what we saw in 2015, 2016, which, by the way, the active rotary rig count increase that Cris highlighted is the most substantial pickup since that period. of 2015, 16. And we know how that turned out for all these energy companies. They got creamed, right? Their stock prices went to single digits, and investors wanted nothing to do with them. So I think that's animal spirits. The lack thereof is a big component of this as well. The last point that I would add is we had an inventory of drilled but uncompleted wells, so-called DUCs back then, where the rotary rig count measures when the drilling rig is working. But after it is drilled, that well needs to be completed before oil can begin to flow, and that's where fracking comes in. And so we had drilled lots of holes everywhere, but had not turned them into actual producing wells. And we don't have that inventory overhang here this time around. So it's not like ready-made production to fall back on. You have to drill a new well, you have to start the new process. And as such, it's very difficult for producers to ramp up production.
Got it. Okay, Juan, I know I left you last, and it's we got 6 different reasons why producers have been slow to ramp it up. Is there anything else you want to add to the list, or would you reorder any of the things that these 2 other guys put forward?
I will add 2 factors. One is related to what the financial situation that Cris was mentioning. And I think the nature of this oil rally is different from the one we had in the 2000s, early 2000s. That one was a demand-driven rally. So for investors, that was easier to see that the rally had it would be a long rally, and it actually lasted from 2002-3 to until 2008, when the crisis in the US kind of killed the rally momentarily, and then it came back again 2009 and 10. This rally is different because it's a supply shock, and it's a lot of there is more uncertainty. It could last 2 weeks, it could last 1 year, it could last 2 years. So there is more uncertainty on. If you are an investor, you have everything depends on the price of oil for you as an investor. So there's more at stake, and I would think they will be more cautious.
That is a very great point that I hadn't even contemplated, but that feels right to me. Right? It's a different prices are up for a different reason that may not be as durable. Therefore, am I actually going to, plunk down these fixed costs that are necessary to start a rig? Yeah, excellent point. Hey, sorry, go ahead, Juan.
The other one was it's more like from the geography point of view. The U.S. doesn't have as much reserves. Shale oil was never supposed to be like 100-year like Saudi Arabia. They can produce for 100 years. Shale oil reserves are maybe they might last 10 years if they keep producing at this rate. So there is more, as time passes on, there is every new, drilling is more expensive, it's more difficult to find, there is more technology required. Every new field is more, difficult. The easy ones are gone.
Got it. So, Cris is biting at the bit here to get in. Go ahead, Cris.
Yeah, well, on that last point, one thing, I was looking at the Baker Hughes report today. One thing that stood out to me was the 92% of the wells are actually horizontal.
Right.
Versus vertical. Well, I would have thought
so
the
explain
opposite.
that. Explain that for people.
Well, maybe the experts can explain. But
explain what that means.
Seems more complicated.
Well, the horizontal is the main technology used for shale formations. So you drill a hole and then you go horizontal because the oil is trapped between rocks and it's not like deep. It's just like spread out. So you have to. There is some guessing when you drill. You don't exactly know how much oil is around that particular well. With traditional extraction, you go deep, like in the Gulf of Mexico. You go very deep, and there is more certainty, like to know how much oil is in that particular field.
And think about tiramisu versus jelly donut, and the vertical is the jelly donut. You go down, you put the straw It comes back to the surface automatically. That's easy. Brilliant. Except, Rockefeller got all the easy ones back in 1900. Yeah.
What kind of jelly, Chris?
Oh, it's got to be cherry. I mean,
Cherry. Oh,
cherry's the best.
I can taste it. Hey, one thing you guys did not mention, which I found a little surprising, and you gave me almost a list of 10 reasons. Nobody mentioned regulation.
Yeah.
What's that all about? I mean, that's all I hear. That's what we heard on the webinar. You guys aren't thinking about regulation. You can't get permits, Keystone Pipeline, so forth and so on. What's going on there? Doesn't that matter? It's not even on your list. Cris,
No.
Lapakis, Juan, Tom.
it's not on my list.
Not even on the list. Whoa.
Yeah. I mean, it's just, there's things that actually matter, and then there's things that people talk about, and sometimes those don't exactly match.
Okay. Anybody want to
isn't-
push back on that one at all?
I'll play devil's advocate. Why?
Okay, yeah.
Why not? Why isn't Keystone XL an issue here? Right? Wouldn't we be in a better position had that been approved?
Flows from Canada.
Well, that was supposed to bring the oil from Canada. It's not doesn't have anything to do with the U.S. production. I think in terms of pipeline, there is not a bottleneck as far as I understand right now. So there is the constraints from the supply side are more about like labor, supplies, drilling equipment, and to me that's the immediate constraint. It's not a legal framework because you can still drill in the Permian, basin in Texas or North Dakota. Those are still there. I mean, there are some limitations in some new areas, but all the traditional areas are still open for. I think I read that the Biden administration said that there were like, I don't know, a big number of permits that were
9,000 permits. Yeah.
So that doesn't seem to be the main reason why.
Okay.
Yeah, I mean,
Tom-
what does this pipeline have to do with the CEO of Continental Resources' decision to drill for some new wells?
I'm sorry, I don't connect those dots, Chris. What's your point?
So that oil, if you built Keystone Pipeline, that would bring oil from Canada into the United States.
Oh, I
But
see.
what does that have to do with the price of tea in
Drilling.
China?
Oh yeah, you're saying that has nothing to do with drilling. Was putting up rigs here in the U.S. That's not going to make a difference. Yeah. Okay. Tom, did you want to say something? I saw your hand. No. Tom
Nope.
Nichols.
I think
No?
they
Okay,
nailed it.
fine. Okay. Okay. Well, while we're on the subject, the other thing I wanted to ask is kind of the way I think about this in my frame is that you got to, you're not going to put up a rig unless you can make money, right? And if you think about the cost of, putting up a rig and start pumping oil, that's variable. It varies over time. Right now, it's probably on the high side because labor is more expensive. The cost of sand, all the other materials is more expensive. The cost of capital, as you guys pointed out, is more expensive. So my thought is that for the typical well here, rig in the U.S., it's somewhere around $75 a barrel, maybe. It could be even a little higher than that. So you need to get above that price on a consistent basis and believe it's going to stay above that price for an extended period before you actually plunk down the dollars to invest to open up a rig. And if you look at the data, oil prices really didn't get much above $75 a barrel for any length of time, at least not long enough that would give anyone confidence that it's going to stay there for very long. And before Russia invaded Ukraine, before it got on the radar screen at the start of this year, oil prices were $75 a barrel. So from an economic perspective, that's just economics, right? I can't make money. Therefore, I'm not going to put up a rig. Therefore, that's why we hadn't seen more rigs. Does that, and I know $75 is, highly variable. It's hard to measure and who knows. And that's kind of the typical, that I'm painting with a broad brush. Some rigs can put up more cheaply, some more expensive, but on average, what do you think about that frame for thinking about this in terms of answering this question, why we haven't seen more rig development? What do you think? Tom, Cris, Juan, anybody? Do I have this right? And is that a good frame?
I think the break-even point is that's the key variable for drilling.
Yeah.
No? So I think that a good source for that is that the Dallas Fed, they release a survey every year, every quarter, and they ask all companies, what is your break-even point for drilling? Last year, they do it that question goes into like the first quarter of every year. Last year, I think it was around 60, 55 to 60.
53.
53. I expect that this year's is coming up maybe next week. It's coming up soon.
2
And
weeks.
I expect a big jump in the break-even point.
Yeah. So you think my $75 might be roughly right, or maybe we'll see, I guess, in a week.
That will be a huge increase.
Yeah, it's
That-
going to be
that sounds
lower
high.
than it's going to be lower than 75, but it's definitely going to be higher. I mean, because as
Yeah.
Tom mentioned, you know, the cost of sand and drilling rigs and labor have all increased.
Got
But
it.
I mean, so the survey typically moves by, you know, 5, maybe 10 would be like a huge increase. So I mean, I think it goes back to these 10 reasons that we gave you of why the U.S. producers have, even when it's profitable for them to drill, have not drilled.
Got it. Okay. Well, let's
could
move
I-
on with the game. Oh, I'm sorry, Tom. Go ahead.
Could I briefly interject one thing?
Yeah.
I just want to define the difference between a rig and a well.
Okay.
I think some people use them interchangeably, which actually isn't right.
I do.
a-
So
Yeah,
please,
so a
feel
rig,
free.
a
Yeah.
rig drills a well. A rig
rig
creates
drills
a
a
well,
well.
and then a
Okay.
well produces oil. So a rig can
Okay.
create multiple different wells.
Okay.
So when you see the rig count rise, that doesn't mean the number of wells. That means the number of people who are drilling new wells.
Got it. Got it. Okay. So you can have multiple wells off of one rig.
And you
Right.
do. Yeah.
And you do
yeah.
typically. Okay. Oh, that's good to know. And does that vary very much? I mean, is it 2 wells or 10 wells or 20 wells? Does it, I mean, or that's just, it's all over the map.
I don't exactly know, but typically the way it happens is a company will hire a drilling crew, and that's when the rig goes active.
I
And they'll
see.
hire them for a certain amount of time, and they'll drill as many wells as they can in that time. They won't necessarily begin production from all of them right away.
Got it. Got it. Okay.
Yeah,
that's
I would say
Well-
probably 8 to 10 is what you would get. And it's, you go straight down and then you start going out in branches in 360 degrees in order. That's the horizontal drilling aspect of, and that's 92% of all drilling in the US.
Chris, you want to?
Well, yeah, while we're on the topic, what is the typical timeline between drilling a well and then the production? I think that's on a lot of folks' mind right now in terms of increasing supply.
Or
Any-
maybe what's the length of time between a rig and then a well,
Drilling a well,
and then you get
and-
oil?
Yes, yes.
What's that like? Is that like weeks? Is that days? Is that months? Or what is that?
It's about 3 to 4 months. So
Really?
once
Interesting.
you see it show up in the rigs,
Yeah.
it's probably another 2 months in terms of when it can actually start impacting production. But you know, if a CEO wanted to make a decision today, the oil would show up probably 4 months from now.
You said 2 months.
Well, 2 months for it to show up in rigs. So you make a decision.
Oh, I
You
see.
have to
I
do-
see.
yeah.
I see. I
So
see.
there's-
I'm gonna increase production. 4 months later, that's gonna show up in oil.
That right.
Got
Yes.
it. Got it. Okay. Hey, we forgot about the game. I think.
Yeah, Ryan.
Let's go back to the game. Ryan, I'm sorry. You're up.
Sorry?
What's your statistic?
11.7.
11.7. 11.7.
Is that a CPI?
It has a CPI. It's a calculation, but it includes the CPI.
Oh,
Calculation.
I know what it is. Is this what you showed me the other night? Where you
No,
said
no, that's another 11%. 11.7%.
that was 11.7.
It
Tell
is.
people
Yeah,
what
I
that
gonna use
was.
both of them. So
Go
that
ahead.
was the retail gasoline price as a share of average hourly earnings for production workers. So, you know, it's risen since the pandemic, but it's still much lower than it was in 2008, 2009.
So the cost of gas per gallon divided by how much dollars per hour for a person working, how much they're earning. So you're saying right now the cost of a gallon of gasoline is 11%-ish of the amount they're making per hour.
correct.
And that by historical standard is
Pretty low.
pretty low, right?
Yep.
Yeah, which is pretty. It goes back to the earlier point that higher oil prices hurt the economy, but not
Right.
that much. Certainly not to the degree that it did 20, 30 years ago. So, like, if
Mhm.
you go back 20, 30 years ago, it was a lot higher. It was like, what was it? I can't remember. Do you remember?
I think it was north of 20.
More north of 20. Yeah, 20%. Okay, but okay. So,
That's
but
not
that
the,
wasn't
that's
your
not the 11
statistic.
points. No.
Okay.
I got it.
You do?
I'll be
Misery
really impressed.
index.
Oh,
Misery
wow.
index.
Oh, good one.
That's awesome. Good job,
That
Chris.
is awesome.
All right.
And Chris usually does not get.
I
these.
know. I know.
That's
This
right.
is like, yeah, this is like the
Oh,
unicorn.
explain the misery index for everybody.
All right. So the misery index is a combination of the unemployment rate and inflation. So Arthur Oaken created this back. Correct me if I'm wrong, Mark. Was it the late 70s, early 80s? That he
I didn't
created
know. I
misery?
actually did not know that Arthur Oaken invented the misery index. Is
Yeah,
that
I
right?
think I forget which president he did it for, but he did
Oh,
calculate it.
okay.
Yeah.
I didn't know that. Yeah.
And it's just a way of measuring, pain for consumers because, what's important to consumers is the labor market. So that's the unemployment rate and inflation. So when you combine them, it's 11.7% today. Average since the 1980s, 8.4, or average since the 1990s, excuse me, 8.4. But it's well below what we saw, when we had, the high inflation in the 70s and 80s. So a lot of people use the misery index as a proxy for, are we headed towards stagflation? So that's why I was surprised. You're hearing about stagflation a lot,
Yeah.
but by definition, stagflation is high unemployment and high inflation. Right now we have high inflation, but very low unemployment.
Strong economy. So it's not stagflation. Maybe
No, it's not
inflation,
stagflation.
but it's not stagflation.
Right,
Okay.
it's just-
Okay. All right. Do you know what the all-time high is on the misery index?
25?
No.
No. Did you just calculate it?
No. Well, I know this. I know things, Ryan.
All right, I'm gonna check this.
Yeah, he
Let me
doesn't believe
think.
me. 22. 22.
Ah.
Me too. Ah,
Not
Really,
that far off.
well,
that was a
I
pretty
don't
good
know.
guess. Yeah.
Yeah.
That's a half the cowbell.
You think that's a good guess? Yeah. All right. Well, all right. I'll give it
think
to
so.
you. It's in the ballpark. It has a 20 handle to it. Okay. I know I'm tough. Crystal Backus is going, man, he's tough. Yeah, I am tough.
No, we're really tough on this. You got to be right. You got to be
I know.
spot
yeah,
on.
Right. So 11.7. So that's high in the context of the past 30 years, but it's been a lot higher. And this goes to another statistic that came out this week is the University of Michigan survey, right? So
Mhm.
what happened
And
there, Ryan?
Consumer confidence fell.
Yeah.
1 year inflation expectations jumped, but that's
Yeah.
not surprising. That's food prices, that's gasoline prices, which cause consumers to expect more inflation down the road. But if you look in the detail, most of it's gasoline. I mean, gasoline just crushes the University of Michigan confidence survey. 81% of consumers expect higher gasoline prices down the road. So I'm not quite sure what the other 19% of people, what they're thinking, but the majority of people know that higher gasoline prices are coming. And that affects their psyche.
Well, that was a good one. And Chris, bravo. That was a good guess.
Yeah, Chris, that was really
That
impressive.
was really quite
For once.
impressive.
Yeah. Thanks.
All right, what's yours, Mark?
Okay, you ready?
Yep.
And I hope this is a good statistic. I'm a little nervous about it, to be frank.
It's this week, right? This week.
Yes, it is this week. Actually, I'm going to give you two statistics because they're related and they might help you, get to the answer. Because I'm a little afraid it might be too hard. The first statistic is 3.41%. Just absorb that for a second. 3.41%. And the second one is 2.35%. 2.35%. Okay. What
All
is
right, so
that
it's-
number? Those numbers, I should
They're
say.
related to inflation expectations.
Very good.
All
Very
right,
good.
now I just got to figure out which one. 'Cause you mentioned
Oh, very good.
is this the New York Fed's?
No, it's not the New York
no.
Fed's measure inflation expectations, although that's a good guess. Yeah.
Oh,
Now,
is
how
it
did you
our-
know I was going to do inflation expectations? You just
I
kind
can
of felt-
forecast you, Mark.
Oh,
Yeah.
yeah.
Whenever inflation
Got a
comes
model
out,
for me now.
Yeah, it's
Yeah.
inflation expectation. Is it
Yeah.
our pulse combination of inflation?
No, and what is our pulse index? What is that for the
Oh, I
listener?
haven't checked. I didn't check this week.
No. I meant in.
Oh, we just take all these different measures of consumer-based and market-based measures of inflation expectations, combine them together to come up with, kind of a summary of all inflation expectations.
Yeah. Okay.
Oh, I
it's
know
not
where
that.
you're going.
Okay.
You're going 5-year forwards.
Oh, very good. Which one is that?
That is the second one.
2.35.
Yeah.
Yeah. 5-year forwards, and 5-year,
All right.
5-year forwards. That's, you tease that out of 10-year treasury yields. And that is what investors are saying inflation 5 years from now will be in the subsequent 5-year period. So this is long run inflation expectations, consumer price inflation expectations, 2.35. That I would say is very consistent with the Fed's target on CPI.
Yeah, because they're based on the CPI, right?
CPI. So,
Yep.
Core the core consumer expenditure inflators say 2, given the differences in measurement and composition, everything else. CPI, if you said 2.35, that would be, in my view, consistent with the Fed's. So the market is saying, investors are saying, in the long run, inflation is consistent with what the Fed has credibility long run. Okay, so what's 3.41?
Is that the difference
Break-even.
between? Yeah, go ahead, Chris. You got it.
Chris got it. He gets
Yeah.
the cowbell, baby. He won.
Right.
Yeah. Way to go, Chris. Although I have to give Ryan credit, don't you think?
Yeah, absolutely.
All right, Ryan, that's for
Absolutely.
you. That's
That
definitely
was
for
for
you.
him.
No, Chris can have it.
Once I heard the 5-year, then
Yeah.
break even was next.
There's 5-year. That's 5-year break even. So what that is you take a look at the 5-year, the yield on the 5-year Treasury security, and you compare that to the 5-year Treasury inflation protected security. So you buy that bond, you get, that yield plus inflation, CPI inflation, and that difference between those two is what investors are saying they think inflation will be over the next 5 years. 3.41%. Okay, that's a problem. That's high. That's the highest it's been, I believe, in the data that we have back to 2003. And I think that's when TIPS started trading.
Correct.
Right back in 2003. It breached the high that we achieved a few months ago before Russia Ukraine, and now we're above it. And if you look at it, since Russia invaded Ukraine, it's moving straight up. It's moving straight up. And that data I just gave to you, that was from yesterday, 3.41.
Yeah, it's tracking oil prices.
Yeah, it goes to oil prices, but maybe it's overstating the case because it's oil, but nonetheless, I mean,
It's still concerning. Yep.
and that's the key, I think, driving factor between two different scenarios. A scenario where inflation kind of moderates back down when, Russia, Ukraine abates as an issue and oil prices come back in, when the pandemic has faded away and supply chains right themselves and labor markets get back to something more normal. But if we have inflation expectations that come unhinged and untethered, then you get into a situation where you might get into some kind of wage price spiral where wages feed on prices, prices feed on wages. That's a much more endemic, persistent form of inflation, and that could be a problem. And that's where the Fed would say, hey, I got to raise interest rates much more aggressively because I got to break that cycle. I don't want to get into that kind of environment and push on the economy a lot harder.
And that's a fodder for a recession.
Exactly. I'd say that's
a
fodder for
concern.
recession. Yeah.
So speaking of expectations, I know you guys are going to go into the big topic. My
no, we've been in the big topic.
All right. Well,
we're coming in and out of the big topic. Yeah. Yeah.
Yeah. I got to run. My kids are expecting dinner.
Oh, you got to go?
Yeah. Sorry.
No.
Please go.
No. That's the first time he's given us the boot there, Chris.
Mm.
But he knows we're in good hands.
Yeah.
Yeah, go
you
ahead.
guys
No,
are-
I'm
are
only
real good.
teasing. I'm
All
only
right.
teasing.
It's
No,
late on a
please,
Friday,
feel free.
so-
All right, Ryan,
take
thanks
care.
very much. Talk
Bye.
to you later. Yeah, take care. Okay, one more thing on oil, and then I want to talk a bit about non-energy commodities, and that's the outlook for oil. Okay, this is the way I'm just going to frame the way I think about this, and then you guys tell me if you think the frame is a good one, if it's right, wrong, how would you change it, so forth and so on. And this is going to the outlook now, because we're talking about the oil price outlook, which is really critical, obviously, to what's going on here and how it's all going to play out. So my thought is that, the issue is demand and supply. And right now, because of Russia's invasion of Ukraine, the U.S. is putting increasing sanctions on Russia. And one of the most recent developments is that the U.S. and some private sector companies, and I think some other countries like Canada, are no longer buying Russian oil. So that means that that's coming off the market, and it might be able to go someplace else. It might be able to go to China or someplace else, but that's a pretty hard pivot, even just physically doing it. Taking it because it's coming into the U.S. or Canada. Now you got to turn around and ship it in another direction. That's not easy to do, and that's certainly not going to happen very quickly. That oil has to be replaced by something, and we talked about U.S. oil frackers kind of kicking into gear, and we might get more oil there. The Saudis might produce more oil, UAE, some other, Iran, so forth and so on. But if you do the arithmetic, and this is an assumption, this is the outlook, I'm assuming that about 1.5 million barrels a day kind of get dislocated here. That's Russian oil that's not being consumed in the global market, and we got to replace that, and that means temporarily higher prices. And that's my baseline outlook, meaning the most likely scenario. And in that, if that's right, and I'm also assuming that Russia, Ukraine, things kind of start to resolve themselves a bit towards the second half of the year. If that's the case, the peak in this dislocation is between now and mid-year, 1 to 1.5 million barrels a day. If that's the scenario, and again, it's my baseline view, that gives you oil prices on average. They're higher now, but on average between now and mid-year of about 100 barrels a dollar. That's kind of where remember, we're $75 a barrel before all this began. I'm saying it's going to average $100 a barrel through mid-year, and then it'll start to come back in. And by this time next year, it settles in back close to that $75 a barrel oil that we had before all of this. And I'm obviously waving my hands here a lot about how things play out in Russia and Ukraine, and obviously it's a mess, and the Ukrainian people are getting just crushed, and it's just very disconcerting to watch. And I don't know how it's going. I don't know exactly how this all plays out, but that's the kind of the working assumption. If, however, things go astray, it plays out less well, and other countries start to impose sanctions on Russia and stop buying oil, and let's say 2 to 2.5 million barrels a day come off, then that's consistent with oil prices that get to about $125 a barrel on average through mid-year. And then in the darkest scenario, even Europe, which is very dependent on Russian energy supplies, says no more. We're going to sanction, and 3 to 3.5 million barrels come offline. And by the way, I didn't mention it, but Russia produces about a little over 5 million barrels a day for export. So let's say 3 to 3.5 million barrels is the peak between now and mid-year. Then you get oil prices that are closer to $150, per barrel between now and mid-year. And if you kind of do the arithmetic, what does it mean for U.S. gasoline prices and U.S. economy, and given all the kind of the ancillary effects that would have on confidence and sentiment and stock prices and inflation expectations and monetary policy, I would say if we get the baseline $100 a barrel, we'll be fine. The economy will grow strongly this year. Everything sticks to script. We get back to full employment by the end of the year, and inflation starts to moderate significantly by next year. But if we get into that $125 a barrel, and certainly that $150 a barrel, that's the fodder for recession, particularly $150 a barrel. That would be gasoline prices, that are well north of $5 per gallon, probably closer to $6, and that would be, given all the nonlinearities in the economy and sentiment and everything else, that probably would mean recession. Okay, that's a long-winded kind of story, narrative, description of the outlook. What do you think? Is that a good way of thinking about things? And let me begin with Juan. Juan, do you have a perspective on this? Anything you would say that about that frame and just the numbers?
I think that I agree with the baseline. It seems the most likely scenario right now. Russia, I think that when we start seeing the data coming, we're going to see a decline in production from Russia, which is probably the same as exports. We don't usually get data on exports, but production will give you that number around 1.5 in the next few weeks. I think there is a scenario that is more. It has more uncertainty than usual for oil prices. because it all depends on a conflict that, who knows how it's gonna play out. But there could be another scenario where prices don't go up to 150, but they also stay higher for longer. Let's say around 100 through the end of the year, just because there's sanctions that are already in place. There's financial sanctions, oil companies pulling out of Russia. That's going to have an impact on Russia's capacity to maintain oil production. Remember that just to keep production steady, you need to invest like aggressively every month just to keep production steady. So if you're not able to do that, production capacity starts to decline over time. So if that's the case, if we say 1 million barrels permanent destruction of capacity, I mean, that could be replaced by Saudi Arabia or other countries, but there are not many countries with that capacity, even to add 1 million barrels. I would say that there is only Saudi Arabia is the only country with that kind of spare capacity. So if Saudi Arabia step in and increases production by 1 million barrels, that will leave the global spare capacity like a very thin. And markets usually react to that.
Yeah, interesting point. Yeah, that goes back to your point about U.S. frackers not kicking into gear because they're fearful that it's a supply shock and supply might come back. But here you're saying, well, maybe not. Certainly not in Russia. So hopefully that kind of starts to work into the thinking of these frackers, and they start putting in more rigs and produce more wells.
And I think it has been in the news that the U.S. met with the Venezuelan government, and that kind of I think it was unexpected. It caught most people by surprise. And Venezuela oil industry is devastated. I mean, they wouldn't be able to increase output by more than 200,000 barrels in maybe like a month or two. But I'm thinking that the government's thinking about approaching Venezuela might be more like a medium or long-term play, because Venezuela has the potential to be a major producer, but it will require a lot of investment, and it will take maybe 1, 2, or 3 years to get there. So there could be a scenario where the government is thinking, well, this situation in Russia is gonna get worse before it gets better, and we have to think more like down the road. How do we get that output replaced from somewhere else?
Got it. Tom, what do you think about the way I kind of framed the outlook and the outlook itself? Anything to add there?
Yeah, so I think the way you framed it is accurate, and that's what I expect as well, about 1 million barrels coming off. There's one little bit of color that I'd add to that, which is that we were expecting, even before the invasion, for a really large increase in supply this year from countries other than Russia. The OPEC bloc is planning on boosting production by a lot. So we were actually expecting supply this year to exceed demand before the invasion, which meant that there was going to be oil flowing into inventories. So even if we lose 1 million barrels per day from Russia, that doesn't necessarily mean that we have a shortfall in supply, that we can't meet demand. Probably we still will be able to meet demand. It'll just be much more evenly matched between supply and demand this year.
Got it. That's a good point too. Thank you for that. And Cris, anything you want to add? First of all, do you agree with that frame and the kind of the numbers broadly, and anything else you want to add?
Yeah, absolutely. I agree with the frame. I think that there's two things I would like to add. One is, as important as oil is, it's not just oil. If I were to throw a number out, the number I would have thrown out would have been 345, and that's the price of natural gas in euros per megawatt hour. And you know what it was last year?
40?
16.
Oh my goodness. Okay.
Yeah. So, and also, the U.S. has actually stepped up to the plate. In December, the U.S. became the #1 exporter of liquefied natural gas, and 2/3 of those cargoes go to Europe. But gas is very important. And then the second point that I would want to make, that's a little bit absent from this conversation. I'm an energy economist, but I'm also a climate economist. And one of the things that we look at are carbon price scenarios where, okay, well, what is the energy price that is necessary to get us off of fossil fuels? Okay, well, here we have basically a carbon tax that has been put in place by Russia's invasion of Ukraine. And instead of running to renewables, everybody wants to drill more, everybody wants to put up freaking
That's a good
coals in the
point.
ground.
I didn't
So
think of it that way.
how is
Yeah.
this transition going to happen? If we get the signal from the market, now we want to undo it.
Yeah. Although,
And
you know,
that
it would
goes
be
to the
nice
misery
it
index,
would be
right?
nice to be able to plan for it and adjust to it, and not
That's
just
the-
like, yeah.
That's where I
Right.
would want, that's where I was trying to go, which is
Yeah.
to say basically, like, if this transition is going to happen, it's going to
Yeah.
have to be a gradual one,
Yeah.
because the
Good point.
political consequences of a sharp and sudden increase are too much to bear for any president at any time.
Got it. Okay, so we're all kind of coalescing around the kind of on average between now and mid-year, $100 a barrel, something like that, which would probably translate into, what would that translate? That translate to pretty close to what, $4.50 for a cost of a gallon of regular unleaded nationwide, something like that. Yeah, that's kind of okay. So that's kind of the benchmark for our forecast. Hey, Jet, I have another colleague here that we've kind of not brought into the conversation. I apologize. Jesse Rogers. Jesse, you've been on Inside Economics already, at least once, maybe more.
Yeah, yes, I have. Hi, Mark. Great to be with everybody. Wonderful conversation.
Unfortunately, you're not going to be with us very long. Because this is what I'm going to do, Jesse. I'm tired. And I think everyone's tired. I'm going to cut the conversation. It was a great conversation about oil, and I don't want to do, I don't want to short shrift what's going on in the rest of the commodity complex, because there's a lot going on. So I'm going to have you come back, okay? And then we're going to talk mano a mano on that. Is that okay? Is that
all right?
Okay
A return ticket.
You got to.
Yeah,
Yep,
I'll
absolutely.
take it. Yeah, I'll take it.
Okay, good. And so we'll have you back in the next week, 2 or 3, to talk about non-energy commodity prices: wheat, corn, neon, palladium, titanium. All the stuff that has gotten really messed up here. Aluminum.
Sounds good. I mean, it's great to have the first cut of all this expertise and all these great views going back and forth. So at least be able to say that I heard it before everybody else.
Well, I do want to thank everybody. Any parting words, Cris, to the group? Anything you want to mention? As we
just thank you to the experts here.
Yeah, well done. I actually learned a lot. Just straightening out those numbers for me on production and consumption was very helpful. I appreciate that. And the tutorial on rigs and wells, all very good. So
horizontal drilling. Yeah.
Horizontal drilling. Oh, of course, jelly donut and tiramisu. How can we forget that? I mean, that's a beautiful thing.
I always use baklava.
Okay.
Tiramisu.
Mr. Lafakis, I'd say the baklava is even. Oh, and you're Greek.
Oh,
what the heck? He took your baklava.
Yeah, I
Oh
went
my
Italian.
gosh.
I mean, I was making an olive branch to Doritos here, with the tiramisu.
Yeah, the Italian
did make me hungry. So
yeah, very good. Okay, well, very good. And obviously, we'll be covering Russia, Ukraine, as we go here on the podcast and webinars on Economic View. Please let us know what else you'd like us to talk about. I mean, obviously, this is top of mind, but we like your suggestions. So with that, we're going to call it a podcast. Thanks, everyone.